Now, here are the words you like to hear. You've gotten the loan. Maybe it's for a new car. Maybe it's for a new house. Maybe it's for a new apartment. But you have been approved because your credit score is exactly what we're looking for. And that's what a lot of lenders talk about. And so today, what I'm going to talk about, and again, my name is Paul Lawrence Van, we're going to talk about the all important importance of credit scores. Now, credit scores typically go through a company called Fair Isaac Corporation or FICO. And what FICO does, it primarily evaluates your particular credit history. I'm going to put a screen up here real fast so that you can see what I'm talking about, and then I'll go into the content. So the FICO score, it's like the GPA, a grade point average for credit. It totals up to 100%, as you can see from this particular slide. And 35% of it goes into the payment history that we have. And another 30% goes into the utilization rate, which 30% is actually, you don't want to go any higher than that. You don't want to go 35%, 40, 50%. You want to keep it below 30%, and that gives you a better reading from the lenders, whomever they may be. And then 15% goes to the age of your account. So let's say if you have an account that's 10 years old, then that's a very good account. It's never been any past due payments, or it's never been behind of any sorts. Then another 10% goes for new credit. And new credit may be something if you're going to purchase a new TV, for example, and you purchase that TV, you pay it over time. You always try to work to pay it early, and then you can move forward. And then lastly, credit mix. So there's a good mix. You have a mortgage, for example, you have a car loan, you have some credit cards, you might even have some student loan, or you might have a personal loan. It all depends. So this FICO score is really very important for all of us in the grand scheme of finances. Now I'm going to take the slide down for just a minute. I'm going to go into some of the better understanding of what this is all about, especially for people who may not be aware of it. A credit score is a numerical representation of an individual's credit worthiness, and we all want to be able to have that credit worthiness. And this, of course, is based on our credit history, which I talked about before. Now, it typically ranges from 300, which is low, 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 to 850, which is about the highest it can go, with higher scores indicating better credit health. So maintaining a good credit score is crucial because it affects the various aspects of financial life, including access to loans, which I mentioned earlier, credit cards, rental agreements, and even employment in some cases. Yes, employers look at your credit score, but it's all good because we know we're working to keep it that way. And a high score can lead to better interest rates, which is the key, and favorable terms on financial products, while a low score can lead to difficulties in obtaining credit or higher costs. And I just want to talk about my personal self. I was trying to get that 850 score, and I tried and I tried and I tried. I couldn't get it. I got up to 820. And so that's really considered excellent credit, but I'm still pushing to get up to 850. People able to do it because I've seen them, but I'm still working on it. So I just want you to understand that it's possible. If I can do it, so can you. Now, credit scores are typically calculated using the FICO or the Fair Isaac Corporation or VantageScore models, with FICO being the most common one. Now, here are the factors of which I've spoken about before. I want to make sure that you understand it clearly. 35% again goes to the payment history. Whether you pay your credit card bills on time is the single most important factor affecting your score. In other words, let's say you go to purchase something, the lender, whomever it happens to be, wants to know if they're going to be repaid. I mean, that's the normal thing. If you purchase something, you should be able to pay that back. Otherwise, don't get it. Don't live above your means, which is what I covered in the previous episode. And by the way, this is episode 277. Oh my God, it's really getting up there. Now, the next thing as a part of FICO score is the credit utilization, and it refers to the percentage of your available credit that you're using. For example, if your credit limit is $10,000 and you have a balance of $3,000, your credit utilization is 30%. So it's recommended to keep utilization below 30% to maintain a good score. Somehow, when you go above 30%, it looks a little shaky to the lenders and whoever happens to be extending you credit for whatever product or service that you've obtained. And then the credit mix, 10%. So having a variety of credit accounts, credit cards, I mentioned before, loans, mortgages, shows you can handle different types of credit responsibility. And I've always been one, I always want to, if I purchase something, I'm going to pay you back. Don't even worry about that because that's my responsibility. And I want to be accountable for the purchases I made. And I know that you do as well. And then you want to look at that new credit, 10%, which I mentioned before, applying for multiple credit cards or loans in a short period signals to lenders that you may be in financial trouble because you're trying to get one credit card, you rob Peter to pay Paul. Just as an example, you don't want to, you want to pay me, but you also want to pay Peter as well. And you want you, of course, you may be in financial trouble, which can lower your score. So each hard inquiry can negatively impact your score. In other words, if you're deciding, well, I'm going to get credit from this company, that business, this corporation, and if you're doing it just one behind the other, it's going to drop your score down, and you don't want to do that. And I also want to say, if you pay off your debts, do not turn in the credit card. Just keep that card, but just use it sparingly, because if you send that card back in, it's going to affect your credit score. And so we want to make sure that we stay on the right side of this. And so now I'm going to put this slide up once again so you can see what I just discussed, the FICO score, or what we call the grade point average of credit, 35%. Repeat after me, 35% for payment history, 30% for utilization rate and no more, 15% for the aging of your credit account, 10% for new credit, but let's not overdo it. And then that credit mix is all important because it shows that you're responsible, that you're accountable for the credit that you have. So I think this is a great chart for that. And then the next thing I'm going to talk about here is the importance of maintaining a good credit score. It gives you the access to better financial products. And individuals with good credit scores are eligible for better credit cards with lower interest rates. And that's the key. You can purchase more with less, for less, is really what it's stating in regards to my research. And then higher credit limits and attractive rewards. So you can get more than perhaps your family member or your neighbor. It's because you've performed the due diligence and you have went out there and you've gotten yourself some excellent credit. And then you want lower insurance premiums. Whether it's a vehicle, life insurance, whatever it happens to be, having good credit scores makes a difference. So in many cases, insurance companies use credit scores to assess the risk, because if you can't pay your bills on time, then your insurance may follow suit, and no one wants that. The higher credit score can result in lower premiums for auto and homeowners insurance. And then employment opportunities. I mentioned that before. I know when I was in the Pentagon, they checked everything. They dotted the I's and they crossed the T's, whether it was a medical exam, credit, whether it was employment, previous employment, whatever it might be. And so some employers in the financial sectors, they check credit reports as part of their hiring process. And a low credit score can raise concerns about reliability and financial responsibility. That's what I keep on saying. This is very important. And then rental approval. If you have a low credit score for rent, they really don't want to put you in there because it may mean you'd be moving out soon, and they don't want to go through that. They want to bring someone in to rent the property and to stay there for a long time. I know this because I used to lease my house out. One of my houses I owned for about 12 years. And it's really good when it's good, but when it's bad, it's not so good. So you want to make sure. And then emergency borrowing. Life is very unpredictable. So there are times when you may have an extensive medical bill because of an emergency, and it will impact you. So if you needed money to borrow to help with that, you could run into a problem if your credit is not good. So how do you maintain a good credit score? Well, as my parents used to say, pay your bills on time, son. Pay your bills on time, young lady. And that's really one of the keys to all of this is that you have to be very responsible for what you do. And then you want to keep your credit utilization low. If you go over 30%, do what you can to get it under there because the interest rate against that particular limit that you have, the total balance that you have, it adds up every month and it actually can put you further and further behind. And as I stated before, don't close old accounts. Keep them open because it's a part of the history. And it's part of the credit score history. So closing an old credit card can shorten your credit history and increase your credit utilization rates. So it's very important not to do that. Then avoid paying for too much credit at once. In other words, each time you apply for a new credit card or loan, a hard inquiry is added to your credit reports. For example, if you decided, well, I need to get a new car. If you do so, there are places out there that you can apply for a loan, and they will actually apply to maybe 10 to 15 different automobile loan sources. And so instead of having 15 on your record, there only be one based on that one inquiry. And that's much better than doing one here, one there, one there. It will just ruin your credit. And then you want to monitor your credit report. And we know that scams are taking place all over the place. And we want to make sure that we monitor our credit and our credit scores because it can do a lot of damages. And so this is primarily what I wanted to talk about today because I talked about credit cards usage yesterday. And today I think it's very appropriate to talk about the credit scores because they go hand in hand. And I'm just going to provide you with an example or maybe two in terms of maintaining a good credit score. For example, Jane has maintained a credit score above 800 for over 10 years. She pays her credit card bill in full each month and keeps her credit utilization below 10%. By avoiding high balances and staying consistent with on-time payments, Jane has been able to keep a stellar credit risk score. Thank you very much, Paul, too. And then the lesson to take from this is that long-term consistency in paying bills on time and maintaining high credit utilization is the key to keeping a high score. And then here's another example. It is to strategic use of credit. Let's say, for example, Marcus only uses his credit card for major purchases like vacations or electronics. What kind of vacations you going on? However, he ensures that the balance is paid off in full before the due date, which is admirable. And as a result, his credit score remains above 780 and he incurs no interest charges. So using credit cards strategically for large necessary purchases or unnecessary purchases are paying them off immediately and can help maintain a strong score without accruing interest. And I think those are two really great examples in which people can consider. And here's what I want to leave with you in parting. So some tips for maintaining a good credit score throughout life is to, number one, keep your balances low. That means you're living within your means. Set up automatic payments, which means your utilities or your car payment or your mortgage payment are all paid. That way you won't be late with them. And then diversify your credit while maintaining a healthy mix of credit types, the credit cards, loans, mortgages. If you don't need them, don't get them. And then check your credit regularly because we have all the hackers and scams out there. And then limit hard inquiries. So by understanding how credit scores are calculated and making strategic decisions, consumers can build and maintain a good credit score throughout their lives. And this will provide you with access to better financial opportunities to help you to avoid the pitfalls of bad credit. And none of us want bad credit. And so this is going to conclude this session. Thank you so much for your time. My time is up and I thank you for yours. Get out there and watch this episode at www